Good afternoon, it's Christian Thwaites from Brown Janikowski, Friday, December the 18th. Well, this was the week where the Fed finally raised their rates. We talked about that on Wednesday when they actually announced that. And what's happened since then is that markets had a quick reaction, but are mostly steadied back in. So a short equity rally, which has since reversed. The dollar has strengthened a little bit, but the major story was that oil came off by about 5%, primarily because of concerns about weaker growth, and also because it is priced in dollars and we expect a stronger dollar. The trading most of this week and going into the next week is all about positions unwinding. Very few investors globally or here are making big bets between now and the year end. So we don't expect very much to happen between now and then, and we're flat in most of the markets from the beginning of the month, and indeed most of the year, except for a few outstanding weaker markets like emerging markets and oil. Here's an interesting chart which we think is going to be important for 2016. It shows the rise of the German stock market, one of the better performers this year, in local euro terms, in other words, for a European-based investor, and compare that to the returns for a dollar investor invested in the same market. And this really shows what happens when the dollar strengthens. The differential here is by about 15%. So one area which we're looking for in 2016 is better markets in Europe, and hopefully with the dollar flattening out for better returns for US investors. Thank you very much.